Let us now look at Article 7, Paragraph 1 of the India-USA Treaty. And this deals with when profits can be taxed in the source state. Now let us consider there's a US resident who's carrying on business in India. So India is the source state and US is the state of residence. The profits of an enterprise of a contracting state. So we are taking the example of a US enterprise. So we reread this as the profits of an US enterprise shall mandatorily be taxable only in that state, only in US, unless the enterprise, the US enterprise, carries on business in the other contracting state, which is India, through a PE situated therein. Situated therein as in situated in India. What this says is that the primary right to tax business profit is that of United States or the state of residence, unless the enterprise which we are looking at carries on business in the source state through a permanent establishment. And through which permanent establishment? Which is situated in the other source state, right? Some of the things which you need to understand in this first line is that the word used here are carries on. What that means is that there has to be some continuum, activities over a period of time, which should result in a PE, right? The business should not be a one-off transaction, but it should be something which is carried on as a regular activity, right? In the other contracting state through. Now, take an example of a foreign company which carries on business in India. Let's say this foreign company has a PE in India and it also sells directly to some of the customers in India. As a general rule, the profits which are taxable are those which are generated through the business which is carried on through a PE, which means that the PE should have some role to play in the business profit which we are trying to tax here, right? If the PE does not have a role and the foreign company is doing something directly, ordinarily it will not be taxable in the hands of the PE. But there is something which acts as an exception to this rule, which is called the force of attraction clause. And incidentally, it's there in the India-US Treaty in this very clause. We'll just look at it in a short while. If the US enterprise carries on business as aforesaid, means through a PE in India, the profits of the US enterprise may be taxed in the other state, which is India, right? The use of the word maybe indicates that these profits will also be taxable in the US, of course with a credit for the taxes which have been paid in India, right? But the right to tax such profit in India is restricted. And restricted by what? But only so much of them as is attributable to. The profits which can be taxed in India are the ones which are attributable to that permanent establishment, right? Attributable as in the role or the activities of the PE should be there. Sales in the other state, which is India, of goods or merchandise of the same or similar kind as those sold through that PE. So if this foreign company were to sell directly to a customer in India goods or merchandise which are same or similar to the ones through which the PE is into business, then even the profits from that will be considered as earned through by the PE and therefore taxable in India. Other business activities. Now, here the reference is to sale of goods or merchandise. But any other sale of not goods or merchandise, or maybe services or other business activities which are not covered in B, which are carried on in the other state of the same or similar kind as those effected through the PE. So if the PE is into provision of services and certain services are provided directly by the foreign company to a customer, which are same or similar to the ones rendered through the PE, even the profits from that will be taxable in India. So let us look at an example. Here what is happening is there are three countries which are involved: US, where the foreign company is a tax resident; Netherlands, where this foreign company has a PE; and India, where this foreign company has an Indian PE and a customer. Right? Considering this, let's understand what are the key characteristics of Article 7. 1. Profits of an overseas enterprise shall be taxable only in that state. The right to tax profits, business profits, of the foreign company is with US. However, enterprise carries on business in the other contracting state through a PE, then the right to tax will also be there with the other contracting state. Right? However, the profits which are to be considered is in respect of a PE which is situated in the source state. If this foreign PE earns a profit, that's not relevant for Indian tax purposes, unless the foreign PE itself is kind of an enterprise which is carrying on business activities in India. Only profits attributable to the PE are taxable in the source state, but in some cases there could be a force of attraction clause which may apply to tax the non-PE profits. So if the foreign company sells goods directly to the customer, which are of the same or similar kind as one done through the Indian PE, then even the profits from those can be taxed in India. So profits attributable to that PE, normally, like I said, this is what is taxable under Article 7. However, for certain sale of goods or merchandise, sales in the other state of goods or merchandise of the same or similar kind as those sold through that PE. So if there are sale of goods or merchandise in India, not the sale of goods outside India, but sale of goods in India by the foreign enterprise directly, of goods or merchandise of the same or similar kind as those which are done through the PE, will also be taxable in India. If there is an activity which is carried out by the Indian PE outside India, even that may be taxable in India. But if the PE does not have any role whatsoever in the activities outside India, then nothing further can be attributed. Other business activities carried on in the other state of the same or similar kind as those effected through that PE. The same analogy applies to this as well.